Welcome, folks. Hope you're all doing well. So today we had CPI. Here we are having the daily chart for gold. So as you can see, this is CPI. Today is on Tuesday, February of 2024. So in the morning, during London session, we had this run to the upside, and we had the previous day's high being taken out. So that was the draw, and then we had this low and this low as well. Also, we had this part of this inefficiency that wasn't traded into. So we are having those are the as the discount PDRAs. So we had sell side, and then we had this inefficiency right there. So this would look something like this. So we had not traded into this portion of this fair value gap. So on the 4-hour chart, we had wow. On the 4-hour chart, we had this inefficiency right here, and then we had all these highs that were inside this price range. So we had from if you could have taken your fib, anchor it from this low, yesterday's low, to Friday's high. As you can see, these highs were at premium, and also we had this inefficiency. So it was logical for us to trade into that and then anticipate for shorts during New York Open and CPI. So we had that. So if we head over to the 15-minute chart, today we had several setups on gold. So we had this inefficiency. If you could have taken your fib, anchor it from that low to this high. As you can see, this inefficiency was right at equilibrium, which is almost at a discount. So we had that. So it was at around 22.15. So you can always trade at any time. Does not mean that you just wait for the silver bullet to happen. So we had these shorts. We took out buy side right there. We also traded into this inefficiency right there, and then we had this run to the downside, aiming for these relative equal lows and eventually this inefficiency. So we hit that and then immediately rejected the inefficiency at, as you can see, it traded into the midpoint of this inefficiency. So that was signature that price was willing to not to go down but to go up. So we had these highs, and also we had something like this inefficiency right here as your draw on liquidity. So we had that, went all the way, took out Monday's high right there. You can see we took Monday's high, traded into this 4-hour inefficiency, and as you can see, there was no candle close above this inefficiency. So this is the 15-minute chart. So we had no candle close above this. So we had that run taking out anyone who was short prior to CPI right there, and then we had this aggressive sell to the downside. So we went all the way down. This was the draw on liquidity, and eventually we had that gap. So those were the trades. So if we head over to the 1-minute chart and see how we could have framed those entries. So the first trade was this one. We took buy side at exactly 20:04. So this is the top of the hour, which is the macro. So you can capitalize on that. So we took buy side. The next thing was to aim for sell side, which was below these lows, and also we had this inefficiency. So we equally hit that. So there are two ways you could have gone into this trade. So the thing that I have noticed recently, we are not having this shift in market structure, and then price comes back to the inefficiency and then gives you an entry. So sometimes you have to be aggressive on these entries. So you are having this was an aggressive entry. The minute you saw this candle moving to the upside, you placing your order and then your stop loss just above that high, and then you anticipate for the run. Else there was this shallow run into this inefficiency, that would have been your entry, and then your stop be placed just above that. Also, we had this run all the way up to the midpoint of that inefficiency, then we had now the aggressive sell. So that was the first setup. Here we had the second setup. We had the second setup. So we traded into the midpoint, and as you can see, price respected the midpoint. So we rejected the midpoint, shifted higher. We had a volume imbalance right there, so that could have been your entry long, and then your stop be placed just below the midpoint of this inefficiency. So that was the trade. And then here we had now the CPI. So all this was back and forth, which we refer to as time distortion. So we had this consolidation prior to London Open and 8:30. So we had this aggressive move to the upside. As you can see, there was no candle close above this inefficiency. So you could be going short anywhere in here. There was no time to think. So you're going short, and then after this spike, maybe you could have placed your limit, and then later on maybe placing your stop, because this spike was so aggressive. So that was it for gold. I don't think I have anything else to add to that. It was so simple to determine that. Reason why CPI was bearish is because we were having this run prior to the release to the upside, which was aiming for the buy side. So the next logical thing that was remaining was the sell side, which was residing below these lows and eventually below this long-term, or you can call it the external range liquidity. So those were the three trades that we had, and I hope you found that insightful. Until I talk to you next time, be safe.